actually getting the sales have been the difficult thing with the lack of inventory. Nice house, fairly priced. You're going to have multiple offers. I was at one this weekend, nice, very nice home. It was probably the highlight of our tour. Had 14 offers in 3 days. So that's a stretch on real estate agents where you're showing more and more houses, making more and more offers. So, one thing that we've recognized as a bank is that we got to have a full deck to support all your borrowers out there so you can have every gun, available to you. When you get a borrower on the table, or a home buyer, I'm sorry, you get a home buyer prospect available to you. If they've been affected by COVID because they were a self-employed individual, and maybe, they had a year that suffered in their business, or they're newly self-employed, or it's an investor out there that is looking to get property. We want to be able to pick up everybody out there. So our Maverick line is what we're going to introduce today. Talk a little bit about how we can help you with a fuller array of mortgage options to get all your people financed, and even opportunity to market yourself, to set yourself apart in the market. So with that, Kat, I'm going to lead into your presentation, and glad everybody's here.
Thank you all. Thank you so much for attending, and some really great data that Frank went through with us today. We're going to talk today about the Maverick line that Frank has for you, which is the special financing solutions, non-agency. So when your borrowers are unable to obtain your traditional Fannie and Freddie guidelines, non-agency is the products that you go to seeking out those solutions. So what makes a loan a non-agency loan? Expanded debt to income ratios. Generally speaking, when you're looking at getting a Fannie Freddie loan, you're capped between that 40 and 45 range. These products allow a borrower to go as high as a 50 to 55. Often, I know the reason people exceed DTIs, you may have a spousal situation where one score is higher than the other. One score doesn't qualify, or maybe one of your applicants has, some credit challenges that would exclude them. So we're running it on one person, but we really know there's two incomes in the house. So, a 55 DTI, whatever the situation is, allows for a lot of opportunity to help a lot of borrowers in situations that come up. We can also, Frank and Awful also offer a 40-year term to your borrowers. So this is a term that isn't allowed from a conforming standpoint. You stop at a 30-year fixed. Well, as Frank described, you're in a situation where we have rates rising. We're in a situation where home prices are rising at a record level. And we have 26 to 31-year-olds as the largest segment of the population out getting mortgages at the moment. So it's a perfect storm, if you will, for high debt to income ratios, and for borrowers who need to extend that term out. That 40-year fixed term can solve a lot of issues. Certainly can solve for a borrower who has the appetite for a $400,000 house, but their DTI is capping them at 350. Extending that term out 10 years could perhaps make that dream home more affordable for that particular borrower. The other items that can assist is they do have the 30-year term with a 10-year interest only. Where that going to come into play is a lot of your investors are going to seek out that product. That ability to utilize the interest only payment of that mortgage for 10 years gives that particular investor a higher cash flow. Now, anyone can use that feature. I'm just saying that it is prevalent and sought out by investors. The other item that makes a loan non-QM or non-agency, and by the way, those two terms we interchange in this industry, they mean the same thing. They're just simply loans that are not underwritten to Fannie Freddie guides. They're private label, and the lenders make their own rules, if you will, and decisions, if you will. So no private mortgage insurance would be involved. In the conforming space, when you're dealing with a Fannie Freddie loan and your borrower puts less than 20% down, they have to pay into this insurance fund, and it costs them monthly. right? It's added to their monthly payment. Sometimes it's up front, like with an FHA loan, they get charged at 1.75 up front plus their monthly. So these are uninsured loans. These are private label. The borrower doesn't have to go into that fund and pay that monthly fee to put less than 20% down. So that would make that loan non-QM as well. The other item making a loan non-agency is the ability to do flexible income sources. Frankie alluded to the fact that often you're running into those self-employed borrowers who have great accountants. They want to take every legal deduction they can. And at the end of the day, that net reported income to the IRS isn't substantial enough to qualify them for the mortgage. With your agency loans, that's it. You go off the income of the tax return. If they don't qualify, you're done. We're going to go into several different flexible income solutions that Frank's going to be able to offer your borrower to still attempt to provide a yes to that borrower versus a no. These are all manually underwritten. That makes a loan non-agency. With Fannie Freddie loans, they get run through a software program, DU and LPA it's called, and that kind of spits out findings and tells loan officers what they can and can't do based on those guidelines. Here, it's a manual underwrite. The underwriting team is going to look at the merits of the borrower and analyze that risk from a human being standpoint versus the computer doing that analyzation of that particular borrower. Now, let's talk about income solutions. 34% of the non-agency loans that are closing are currently closing under the bank statement option. So that tells you there's a large segment of self-employed borrowers who are being told no because their income that they report to the IRS isn't enough to qualify. Being a past loan officer myself, I can tell you when you run into that situation as an originator, every time I called the borrower and said, listen, there's not enough income reported on that tax return to qualify you for this purchase, the first thing they say to me is, but Kat, I make a lot more than what I'm reporting to the IRS. That's just what I'm reporting to the IRS. So what we have to do is keep that tax return on Frank's desk. He's not going to use it. We are going to look at an alternative way, and that's going to be the bank statements. The underwriter is going to analyze the deposits in that bank account and take an average of their deposits and utilize it as income. So that's a way to look at what that borrower perceives his true income, right? The income he's reported to the IRS is after all his deductions and expenses and so forth, where we're relying on the deposit base in his bank account. The bank statement feature, we can use 12 or 24 months. When we're in that situation where perhaps you've had a borrower whose income has declined, that can help avoid that situation, right? Because Frank can do an analysis and decide, gosh, is that 12 or 24-month look back going to be better? If I do 24, maybe it's going to be apparent that income is declining, which we all know creates situations in underwriting. Or maybe if I use just that 12-month income, it's not declining, it's stable, and they qualify off of that. And now I can bypass having the borrower explain that and having an underwriter decide whether that explanation is acceptable or not on the declining income. So giving that flexibility to toggle between 12 or 24 months when we're analyzing this bank statements gives Franks a lot of flexibility to look at every avenue in order to qualify your borrowers. That income is calculated relatively quickly. Frank will be able to do that within 24 to 48 hours, let you know the usable income and what that borrower would qualify for. Now, the bank statement feature goes to 90% loan to value. So the borrowers are only having to put 10% down in order to qualify for an alternative income source. The loan amounts go as high as $3 million. So if any of you are in a jumbo market, as we continue to talk about solutions, let's think about those loan amounts that are outside the lending limit that Fannie and Freddie allow. Once you get over into a prime jumbo loan, the guidelines are even more restrictive than Fannie and Freddie often. So this gives the flexibility of helping borrowers, even in the jumbo amount, with some flexible income and using bank statements instead of their tax return. This can be used across all occupancies. It's not just limited to a borrower who's purchasing a primary residence. Think about your second homes, your investment properties. These income solutions can be used across the board for all occupancies. Right now, 42% of borrowers utilizing non-agency product happen to be investors. So they are a segment of the market that's really underserved, I think is what that number tells us, in the conforming arena. They often have issues qualifying from an income standpoint, and this could certainly help if they were self-employed. Now, we have another segment of self-employed borrowers, and that is the 1099 borrower. So, generally speaking, your 1099 borrower is generally a contract employee. As realtors, many of you may be 1099 borrowers. If you are not the broker, you sell your real estate, you get a paid commission at the end of the year. Your broker gives you a 1099. Just like the business owner, you too have expenses you want to write off, right? You have your advertising, your lock boxes, your signs, your gas, etc. So, what can we do for that 1099 borrower? With this borrower, you don't have to gather bank statements in order to use an alternative way to calculate their income. What we can do is use just the 1099. We wouldn't submit the tax return. Frank doesn't have to look at that net reported income after you've deducted everything. We can just look at that 1099 document, use 80% of the reported income on that 1099, and close that loan without him having to submit a tax return. So just the 1099. With the 1099 feature, we can also help borrowers who only have 1 year of 1099 receipt. In the conforming world, agency world, if you will, Fannie Freddie, that borrower needs a 2-year history of receiving 1099 in order to qualify. With non-agency, they only need 1 year of receipt. The key to that is that that borrower is in the same line of work. The reason this guideline exists is because in today's market, we're finding a lot of borrowers converting to a 1099. You have truck drivers who used to be W-2 due to the shortage of workers. They're now contracting themselves out to multiple companies and getting paid on a 1099. You have nurses who are going from W-2 wage earners to traveling nurses and getting 1099s. You have small business owners throughout the country changing borrowers from W-2 wage earners to 1099 purely to save expense, right? Now that expense of paying that match on the Social Security tax goes onto that employee and not that small business owner. A lot of conversions happening due to the recent economic situations with these 1099 borrowers. Frank can also use 1 or 2 years of the 1099. So for that borrower who does have 2 years, what looks better from an approvability standpoint? Is it 1 or is it 2? Again, he doesn't have to rely on a computer or software program to URLP to tell him what he has to do. We can look at what's best for that borrower. Is 1 year best or is 2 years best? Don't know. Let's get them and average it out and see what is the best for the approvability of that borrower. That 1099 borrower using just the 1099 and not the tax return can still go to a 90 loan to value. They don't need any more money down to utilize that feature. And again, it can be used across all of the occupancy types: owner occupied, that second home borrower, the investment property borrower. Can be used to 1 to 4 units as well as condos, as all of our products can. Loan amount goes to 3 million. So again, there's help there for that 1099 jumbo borrower who may not qualify based off of what they're reporting to that IRS. We bypass that and just use the 1099. Now we have another feature, another income solution. That's what non-agency is all about, is solutions. This solution is assets as income. The beautiful feature about assets as income is this is not a depletion loan. You may have heard about asset depletion loans or may have had a borrower where they executed that depletion of their asset to qualify. Here, the borrower gets to keep their asset intact. They don't have to deplete it. They don't have to take out any sort of monthly amount in order to qualify for that mortgage. They leave that asset right where it is, earning the interest that they want it to earn. We're simply going to do some math on that asset and use it as income without the borrower having to take it out of whatever vehicle it is he's holding that in. The assets can be liquid or non-liquid. Frank can even use a retirement asset for a borrower who's not of retirement age. Fannie and Freddie require that borrower to be 59 or 62 to use that asset as income. Here, there's no age restriction to use that retirement account. Frank's just going to make sure that that borrower can access that account in the event they need it to make their payment. Can they take a loan? Can they take a hardship withdrawal? And then he's going to be able to use that retirement asset as income. You can go as high as a 90 loan to value again on that. We can use these assets as income both to supplement that borrower's primary source of income or as a standalone. What do we mean by that? Let's say Frank looks at that 1099 income, or maybe he's using bank statements instead of tax returns, or maybe it's that full doc borrower. He's using traditional income documentation. And you still can't fit that borrower into the program based on their debt to income ratio. We can supplement their primary source of income with their assets and solve that problem without that borrower even having to touch that asset. The other way Frank could use this product is in the event you have a borrower who currently has no income stream, but they have heavy assets. A lot of relocation borrowers find themselves in that situation. I sold my home. I have to move to a new home. I want to buy one. I don't want to rent, but I don't start my job for 60 or 90 days, so I don't have a pay stub I can produce. All I have is an offer letter. Lenders don't close borrowers' mortgages based off of offer letters. They got to be on the job and have at least one pay stub. So we know in today's market, as Frank talked about with that shortage of inventory we're all dealing with, that seller's not going to wait 90 days for that borrower to start his job and give that lender a pay stub, clear it through underwriting, and then close. So if they have heavy assets, for instance, a borrower we closed with $3 million in assets, they were in between jobs. They didn't have any income we could use from employment, but they had $3 million in a stock account. Dividing that out, it netted just over $20,000 a month in usable income. That borrower got to keep that asset sitting right there. We didn't have to worry about the fact that they were between jobs and don't have any employment in this time. We just simply qualified them on their asset. So think about these situations as they come up. Frank's going to put the pencil to every file, look at all these situations and see what combinations he can come up with to give you the ability to say yes to more of these borrowers. Now, the assets as income, that goes down as low as 680. All of the other income solutions we talked about go to a 620 borrower. So you got some flexible FICOs, if you will, on these products. Again, up to 3 million in the loan amount. Owner occupied, investment, second home, doesn't matter. You can qualify standing all alone on your assets if that resolves whatever issue that borrower is having from a traditional financing standpoint. Now, there is going to be another segment of borrower that we run into. You will find that the bulk of your borrowers will be above that 720. They will be well qualified, but you do have a segment of the population who's run into some credit challenges. They have had some late payments over the past 12 months on their mortgage or their rent. It's been a challenging time, so we can help those borrowers as well. We will help down to a 560 FICO. That's low FICO here. We'll also allow that borrower to have 30 and 60-day late payments on their mortgage or their rent over the past 12 months. This product also can be used for investors. We know there for some time was a reprieve on borrowers paying their rent. Well, the person owning that home still had to pay their mortgage or they had to go into forbearance, right? So that whole domino effect with investors, you may find some of those borrowers in the investment category who had some challenges making their payments over the last 12 months. So we're going to be able to help credit challenged borrowers as well with those 30 and 60-day lates. Seasoning is something that is looked at when it comes to major credit events like bankruptcies and foreclosure, short sales, and deed in lieu. So the credit challenge or expanded product also is going to give Frank the ability to have some lighter seasoning than what your agencies generally allow when you find yourself a borrower who's had some major credit events come up in their lives. So whether it's owner occupied, whether it's a second home, or whether it's an investment property, the credit challenged Maverick product will afford you an opportunity to help these particular borrowers get back on track with their mortgage, or perhaps they're a borrower who just sold their home and their FICO, was low. Now they've got that cash to reinvest in a new home, get back on track, but their score isn't allowing them to because of the Fannie Freddie and government guides. So a lot of different situations can come up for borrowers, and that's where Frank's going to be putting the pencil to these loans before he says no and exhaust all these possibilities for you and your clients. Now, let's talk about another group of borrowers who have challenges getting a mortgage, and that's your investors. DTI, debt to income, often is a challenge for investors. Another challenge investors have is Fannie and Freddie limit the amount of finance properties you can have to 10. If you have more than 10 finance properties, where's that borrower going to go? Often they wind up in hard money. Well, they don't have to wind up in hard money. These products allow the borrowers to have up to 20 finance properties. This DSCR loan, you may have heard that term thrown around, debt service coverage ratio, cash flow, DSCR, all mean the same thing. These are no income, no DTI, no debt to income calculated. We don't look at how much debt they have in relation to their income. There's no income documentation gathered from that borrower at all. What we're looking at is that investment property. What kind of rent does that property bring in? Does the rents from that property cover our borrower's payment by 100% or more? If it does, all the way down to a 640 FICO, which is relatively low, we can help that investor build his portfolio, refinance, cash out his property without worrying about what that income looks like. We're only concerned if that borrower is covering his payment or not with the rents. It is for investment properties only. No personal income at all. We're just looking at the rental income. We can also do vacant properties, right? Not every purchase will have a lease in place. You could be selling someone's primary residence to an investor. Well, there's no lease. So we use what they call a 1007. That's an addendum to the appraisal that Frank orders every time you do an investment property. What it does is it tells the lender what the average rents in that market are. So we'll use that. If that amount covers that payment, that's the end of that qualification for that borrower. Very streamlined, low doc loan. We can even help a borrower who is possibly not covering their payment by 100%. There are some pockets in the country where your rents are not keeping up with your payment, with your pitties. So we can help a borrower who's covering their payment only by 75%. So if my payment is 1,000, the rents I'm collecting is only 750, I'm in a deficit, right? I'm not covering that payment by 100% with the rents I'm collecting, but I'm at least covering it by 75%. Now, those borrowers will need a higher FICO. They'll need a 720 if they're in a deficit. But remember, 63% of borrowers utilizing non-agency product are above a 720. So you can even help those investors who are not covering their payment by 100%. as long as they have that higher FICO. You can do this on 1 to 4 units, condos qualify, and the maximum loan to value is going to be 80%. Again, that loan goes as high as 3 million. So no matter what market you're in, if you're in a market where you have investment properties in that jumbo territory, you're okay on this no income loan using the cash flow all the way to that 3 million. These loans are very streamlined, very low doc. Your investors love it. They don't have to give you your tax returns. We don't have to look at that Schedule E and see what they're reporting. And it's a great way for someone to build their investment portfolio when the rents on that property can cover their payment. That concludes all of the solutions that we have. So, from a borrower who needs bank statements or maybe 1099 only, maybe we need to use a combination of those income solutions, include their assets to make that loan work. That borrower who's in between jobs, who have assets, we can help. The investor who doesn't want to show us any income, just wants to qualify on the cash flow. Multitude of solutions for your borrowers, and Frank will for sure put the pencil to each scenario that comes across his desk in order to see if there's an alternative way to close that borrower. We'll certainly toss it back to Frank there with any questions. If anyone has anything they want to add or ask, there is a chat feature there. You can also unmute yourself. I did give you that capability, and we can utilize the remaining time for any questions anybody has.
Hey, Kat, Frank again. I noticed on the last calls that we've done that a lot of people will hit me like right afterward or when we're reaching them up with a specific question, just because we're in a group and that is what it is. Was cool, but I thought I'd share just a couple of them that I had afterwards. I had the last one that we did, I had a realtor give me a call, and I don't know if he's on here or not. I didn't see the attendee list, but he just recently moved to the Florida area, and he's a real estate agent. So he's going to be reestablishing his business, but he's also an investor. He's had some, rentals in the past and that type of thing, and he really wants to, get the investments going again personally. And so this is a solution. The DSCR is a solution for this individual, where instead of having to go out and get hard money or whatever other options he may have looked into, we can finance him through the debt service coverage ratio, because I don't have to worry about any of his income. I don't have to worry about any of his personal expenses and that type of thing. So that was a real world one right after our last call that I had somebody hit me on. And then I'll just for do food for thought for the realtors out there, how you possibly can use this to position yourself a little bit differently as a little bit of a niche type of individual in the market. Self-employed, I have one of the most recent ones that I did on the bank statement program. A meat packing company in southern Indianapolis, or south side of Indianapolis. They've been there for about 25, 30 years, well established, but their tax returns are creative, and there just wasn't any income there that you can do your standard conventional loan, which I would love to do for them. And if they fix their tax returns ever, I'll be more than happy to refinance it. But meat packing company, tax returns just didn't have the income there. We took 12 months worth of bank statements, got them into a new house, because they were buying a new house on the south side, and they got turned down by a couple folks. And then one last one that I'll share is on the investor side. Really, the bank statement and investors are the big ones that I'm having come to me through real estate agents and just directly to me. The I have an investor that came to me down in southern Florida. They're in Lee County, rather established. There's a group of investors down in that area, and if anybody's from here, you probably know some of the folks. But there's a group of them. So well-established people that are doing this, multiple properties they manage and that type of thing. But like a lot of other investors, the tax returns are pretty creative as well. So we're actually going into his portfolio of homes that he put on some type of hard money at one point in time, or institutional money at higher rates and that type of thing, and just doing straight up DSCR. We don't have to worry about his tax returns or his 1099s or anything. It's doing them straight up DSR, able to reduce the interest rates, 3 or 4%, put him in a better cash flow position to go out and get more property. So just a few real world examples. And I know if anybody wants to unmute, have any questions, be more than happy to field them. But certainly afterwards, we'll have some follow-up sessions. But great job, Kat. Anybody have anything? You always do such a thorough job, Kat. Really, you should probably skinny up your presentation, like leave some gaps in it where people go, "Wait a minute," you know.
Frank, I'll take that coaching from you. You got it. Well, thank you everyone for attending, and thank you, Frank, for sharing all those scenarios. And have a great day. And reach out to Frank with your questions. Thank you, everybody. Happy selling, and we'll talk to you again.
Cool. Thanks.